Now we're going to look at the British pound versus the US dollar. In this instance here, we'll start, say, at this bar here, a bullish bar, close above the mean, close closer to the high than to the low, given a higher probability that the high be taken out the next day. The high was taken out. The next day, we got a bar that was probably slightly bearish. Not a very clear signal. But again, with trading price action and associated rules that we teach, you would have known where your stop was. In this instance, probably was the probabilities were to break the low of this bar before the high. What did it do? It came down and broke the low, came back up and broke the high, and now you've got an outside vertical bar. Again, the close was above the open and the close was slightly above the mean, but a 50-50 bar. Broke up, so that signal there was say at about 156. Broke up, bullish bar. High was broken, the low wasn't broken, but again, close slightly below the close, slightly below the mean. I can tell by looking at that bar it was below the mean, given the probability of this low being broken to the downside rather than the high being much greater. What happened? Broke the low. But again, in this instance, it broke the high. A prime example in real trading, what happens here? A little bit of a whipsaw. Again, formed a bullish bar. Inside vertical bar, bullish bar, bullish bar, bullish bar. So for your whipsaws round here a little bit with your stops, and all of a sudden the market takes off and you go from 156.50 and you get a clear signal right up to 158.50, 200 point or 200 pip move, I should say, trading the currency before you got your first negative bearish bar here. Now you can see here what happens. It doesn't break the low of this bar. A small range bar compared to the previous bar, and therefore if it breaks the high, that's quite a bullish signal rather than breaking the low. If it does the opposite to what it's supposed to do, that can give you quite a strong signal in the other direction. Again, your stop, using protective stops, would have protected you, that you would, yes, have taken a loss, but it would have been a minimalistic loss. Again, you have a bullish bar and a bullish bar, and the market would more than compensate it this signal to this signal. Now that's just looking at a very brief example, and again I have to stress, this is just looking at a single vertical bar over a daily time frame period. So in other words, each vertical bar represents one day. Please, I cannot stress enough, the price action is much more than analysing a single vertical bar. If it was that simple, and everybody would be doing it. There's a little bit more to it than that. And certainly when you go into what we call and what we teach in our seminars, the vertical bar trading pattern, which is very simple and very easy to see in any chart in any time frame. But you have to start at the foundations, and the foundations is learning to analyze a single vertical bar. In our next video series we will be teaching the dual vertical bar, the inside vertical bar, and the outside vertical bar. I hope you enjoyed. Thank you.